All right, Steve here. Welcome to today's Explainer. The 4 p.m. bell just rang, and the numbers on the tape? Well, they're the official closing prints from Monday's session. Let's just cut right to it because while the retail crowd spent the entire weekend chasing headline hopium from international summits, the smart money was busy. We are watching a massive institutional liquidation from the Friday close, combined with a structural regime change at the central bank. Bottom line, if you're trading on political press releases today, you're the one being traded. Let's cut through the noise and look at the verified reality.
Here are the 5 dockets on today's ledger. We've got the Monday close, the Warsh regime change, oil geopolitics and tolls, the bull versus bear scenarios, and finally, your trading directive.
Section 1. The Monday close, the reality check.
That record-breaking melt-up we saw midweek, it just ran face-first into a brick wall of macro reality. Just look at the sheer weight of the institutional distribution on the tape today. The S&P 500 failed completely to mount any meaningful bounce above that psychological 7,400 floor, closing real heavy at 7,403.05. Meanwhile, Brent crude is surging, punching straight through resistance to $111.34 on the back of escalating drone strikes in the UAE and Saudi Arabia. And you've got to pay attention to this classic liquidity flush. Gold is pinned under pressure at 45.40, and Bitcoin is snapping support, dropping hard to stalk that 76,981 mark. What's happening? Participants are liquidating whatever they can just to cover their margin calls.
Section 2. The Warsh regime change, the red folder.
We are staring down a structural macro shift at the Federal Reserve that literally kills the easy money guard. The transition from theory to reality, it happened this weekend. Jerome Powell's term has officially expired, and following a historic 54-45 confirmation vote, Kevin Warsh is now sitting in the chairman's seat. Make no mistake, Warsh is an absolute institutional hawk. He has openly blamed past policy errors for anchoring structural inflation right into the system. So for anyone out there still expecting a central bank safety net, I hate to break it to you, but the party is officially over.
Now here's where it gets critical. How does Warsh's arrival collide with a 3.8% year-over-year consumer price inflation rate? Wholesale pressures are accelerating, and Warsh is trying to manage a balance sheet reduction smack in the middle of an energy crisis. With institutional desks like JP Morgan predicting rates are going to remain completely steady through year-end, the math is pretty simple. The present value of future earnings is shrinking. Those massive PE multiples on tech, they simply have to contract.
Section 3. Oil geopolitics and tolls. Ground truth in the water.
Let's shift our focus away from domestic monetary policy and look at the escalating maritime crisis. Because, honestly, there is a massive divergence right now between what the talking heads are saying on TV and the actual ground truth out in the water. Tehran has officially established the Persian Gulf Strait Authority. Guys, this isn't a de-escalation. It's a blatant attempt to turn an international waterway into a weaponized toll booth, collecting transit fees and barring hostile vessels. The impact? A looming, massive global supply shock. Restricted tanker traffic is disrupting a route that normally handles 20% of the entire global oil trade. That's forcing Western economies to burn through strategic reserves at an absolutely unsustainable rate. We've already passed a 1 billion barrel cumulative global inventory drawdown.
Let's look at how this builds into a really explosive geopolitical timeline. Iran is pushing this incredibly aggressive tolling posture, right? But internally, they are facing a massive 25,000 megawatt domestic grid shortfall right ahead of summer. Over 2,000 of their network zones have sustained deep structural damage. Because of these internal mechanical failures, the administration's original timeline to target Iran's civil infrastructure is accelerating. Trump's diplomatic patience has a definitive shelf life. If international commerce remains blocked by this new toll body, the threat of kinetic strikes moves directly to the execution desk.
Section 4. Bull versus bear scenarios, the divergence.
As these twin catalysts collide, a hawkish Fed and a Middle East supply shock, we need to lay out the two extreme paths this market can actually take from here. The bullish view? We'll call it the diplomatic escape. This scenario bets that domestic energy starvation forces Tehran to accept back-channel mediation, dropping Brent crude back to $85 and triggering a massive S&P short squeeze up to 7,500. Conversely, the bearish view is the stagflation spiral. If Iran enforces these asymmetric restrictions and maritime operations actually go dark, while $111 oil was a bargain, we'd be looking at an immediate supply shock sending Brent to $150, and a complete, utter liquidation of growth equities.
Section 5. The Trading Directive. Actionable rules for Tuesday.
All right, enough macro analysis. It's time for the strict, unyielding trading directives you need to actually survive the Tuesday session. Ignore the noise. Follow the tape. Pull up your 1-hour charts on the ES contracts, your S&P futures. The low printed near 7,353 before a minor late bounce. But your absolute line in the sand is 7,400. If the S&P fails to hold that 7,400 level for more than 2 consecutive hourly prints tomorrow morning, the technical breakdown is confirmed. Failing to hold it guarantees a violent retest of deeper structural support.
Next, look at your BZ contracts, your Brent crude. At $111.34, this is literally the only honest chart on your screen right now. Consider this your truth meter. If crude edges toward $113, the market is screaming at you that an escalation is imminent. Do not, under any circumstances, buy the dips in tech while crude is gapping higher.
And hey, if you need a masterclass in market discipline right now, just look at Greg Abel and the Berkshire team. They are sitting on a record $397 billion in cash. They aren't out there chasing this market. They know that locking in a 4.5% risk-free yield is the absolute smartest place to wait while over-leveraged structures just capsize under the weight of a hawkish Fed and structural inflation.
Which brings us to your final rules for Tuesday morning. Keep your sizes small, keep your stops tight. The ledger doesn't wait for latecomers. Stay disciplined, watch your averages, and respect the tape. So I'll leave you with this. Are you positioned for the liquidation, or are you still trading on hope? Think about that before the morning bell. This is Steve. The ledger is closed.